Have you ever looked at the world's wealthiest individuals? The billionaires who hold massive amounts of property or stocks, and just wondered how they do it.
How they fund these incredible lifestyles, their new companies, all while reporting, almost no taxable income.
Exactly. It really feels like they're playing a completely different financial game than the rest of us.
Well, it's not really a secret. It's more like advanced financial engineering. The systems in traditional finance, or TradFi as it's called, they're often structured to heavily reward holding assets that appreciate.
So it's not about the salary you earn.
Not at all. It's about the assets you own. They use this mechanism that allows them to pull value from those assets without ever triggering the tax events that crush the average person who's just earning a salary.
And that is the core puzzle we are getting into today. We are doing a deep dive into this incredibly powerful, decades-old strategy. People often call it the rich person's cheat code.
It's known as buy, borrow, die, or BBD.
Right. And this isn't some newfangled idea.
Yeah.
It's been used by dynastic families for generations, leveraging things like, huge real estate portfolios, art collections, blue chip stocks, all to compound wealth over time.
But the financial world is changing, and our mission today is to explore a pretty profound, and I should say, theoretical application of this.
We're going to try applying this really sophisticated tax-efficient strategy to a modern, very volatile, high-growth asset.
Bitcoin.
Exactly. We're unpacking this concept based on some detailed analysis that's been happening across the community, including some great insights from channels like Sats and Sound.
And this is where we have to be extremely clear. A huge note of caution here.
Okay.
We are exploring this purely as an advanced financial idea, a future possibility. Trying to implement this with Bitcoin right now, it relies on really complex debt management, deep financial knowledge, and, this is the big one, stable, trustworthy lending platform.
Which in the crypto space is still a huge question mark.
A massive one. Given the market volatility and, more importantly, all the regulatory and platform issues, attempting this strategy safely right now carries extremely high risk. We're talking specifically about what's called counterparty risk.
So just to be clear for everyone listening, we're here to educate you on the mechanism. This isn't financial advice in any way.
Not in any way, shape, or form.
Okay. With that necessary caution established, let's unlock the engine that really drives this kind of generational wealth. Because once you understand the mechanics of buy, borrow, die, you start to see why the entire tax system seems to reward holding on to assets, not earning a wage. So let's unpack these three pillars of BBD. Sounds so simple on the surface, but the real genius is in how these three actions play off each other legally.
Right. The primary goal, when you boil it all down, is to avoid the two great wealth killers.
Which are?
Income tax on the cash you need to live your life, and capital gains tax on the value your assets create over time.
Okay, so let's start with the absolute foundation. Pillar 1, which is buy and hold. This one seems pretty easy to get your head around.
It is. You acquire and hold assets that you believe have robust long-term growth potential. But here's the absolute core rule, the one you can never break.
What's that?
These assets are never sold.
Never.
Never. That is the critical element. By not selling, the wealth just keeps accumulating, tax-deferred. The growth in value, what accountants call the unrealized gain, it's not recognized by the tax authorities as income.
The moment you sell, the game stops.
Exactly. The game stops, you realize the gain, and the government steps in to take its share. So the buy phase is all about becoming an asset accumulator, a perpetual long-term holder. You have to find assets you truly believe will grow and grow robustly for decades.
And the ideal asset for this, it seems, whether it's land or gold or maybe a digital asset, it has to appreciate faster than the cost of the debt you're about to take on.
Ah, now you're getting to
Which brings us right to pillar 2.
borrow.
This is the move. This is how the wealthy get access to huge amounts of cash without it ever showing up as taxable income.
Precisely. When they need liquidity, maybe to fund a new business, pay for college, or, buy a super yacht, they don't sell their stocks. They don't liquidate their holdings.
No, they leverage them.
They leverage the asset's accumulated value. They go to a lender and use that highly appreciated asset as collateral to get a loan.
And here's the key legal loophole.
It's not even really a loophole. It's just how the law is written. Money you get from a loan is legally classified as debt. It is not income.
And that's the first huge tax avoidance step.
It's massive Because it's debt, you legally avoid paying income tax on what could be an enormous sum of cash you just pulled out from your asset's growth. You just owe the bank the principal and the interest, which you can pay with other income
Or even by borrowing more if the asset keeps going up.
if it appreciates enough to justify it, yes. You can just keep the cycle going.
So you're extracting cash tax-free.
Yeah.
And your main asset just keeps on compounding in the background. That sounds incredible.
Yeah.
But eventually, someone has to pay the tax bill that's been building up, don't they?
You would think so.
Which leads us to the final and maybe most surprising pillar. Die. This is the ultimate move in the intergenerational transfer of wealth. This is the secret sauce.
It is. And this is where we need to talk about something called the step-up basis. This is, I would argue, the most powerful part of the entire framework, especially in tax systems like the one in the U.S. It's what lets families legally cleanse decades of compounded gains.
Okay, let's spend some serious time on this because honestly, it sounds almost like fiction.
Sure.
How does the step-up basis legally wipe out millions or even billions in capital gains tax?
Think of it like a financial reset button. So normally, when you sell an asset, your capital gain is calculated based on your original cost basis.
What you first paid for it.
Right, what you paid for it. But in many places, when an asset is passed on through an inheritance, its cost basis gets stepped up to the asset's fair market value on the day the original owner passes away.
Whoa, wait, let me just challenge that for a second to make sure I understand. Let's say I buy a stock today for $100, but my parents bought that same stock 40 years ago for just $1. What happens when I inherit it?
Okay, great example. So let's say that stock is now worth $10,000 on the day your parent passes. Your cost basis, as the heir, immediately resets. It's not $1 anymore.
It becomes $10,000.
It becomes $10,000. So if you, the heir, decide to sell that stock the very next day for $10,000, what's your taxable gain?
It's zero.
Zero. The entire $9,999 of appreciation that was built up over 40 years is effectively wiped clean from the tax books. It just vanishes.
That is the crucial insight. The massive wealth creation, the entire lifetime's worth of growth for the original owner, is never subjected to capital gains tax.
And that is the very definition of generational wealth compounding. The asset keeps growing tax-deferred, the owner pulls out tax-free liquidity with loans, and when they die, the debt and the asset pass to the next generation.
Who get a fresh start on the tax clock.
A completely fresh start. They can then choose. They can sell the asset to pay off the loan, and since the basis was stepped up, they have almost zero tax liability on that sale. Or they can just continue the cycle. Hold the asset and take out new loans against its newly stepped-up value.
This sounds almost too generous to the wealthy. I have to ask, why did governments even create this rule? Is it just a loophole they left open?
It's not really a loophole. It was designed with some specific intentions. Historically, one reason was to prevent what's called double taxation. The entire estate might already be subject to an estate tax when it's transferred.
So this avoids taxing it twice.
Right. And another big reason is liquidity. Imagine if the cost basis didn't step up. Heirs inheriting illiquid assets like a family farm or a private business that has grown hugely in value over generations, they'd be forced to sell that asset just to pay the massive capital gains tax bill.
Which could cripple the business or force them to break up the family farm.
Exactly. The rule is meant to ensure some economic continuity.
But the unintended consequence, especially when you apply it to very liquid, fast appreciating assets like stocks or real estate, is this. This creation of a perpetual tax-free wealth machine. It fundamentally rewards being a non-seller.
That's it. You've nailed it. And that powerful mechanism is exactly why we're now exploring Bitcoin. If the system works so flawlessly for stocks and real estate, what makes Bitcoin a candidate for this ultra-wealthy framework?
Right, because for this BBD strategy to actually work, the asset itself has to have some very specific characteristics, financial, structural, even cultural qualities that let someone commit to holding it for a lifetime.
And Bitcoin, surprisingly, checks a lot of these boxes really well.
Okay, so the first, and I think the most obvious quality, is long-term growth potential. Without that, none of this works.
Absolutely not. The math here is non-negotiable. The interest rate on your loan must be significantly lower than the long-term compounding growth rate of your collateral. It has to be.
In Bitcoin, over its, 16-year history now, has shown this incredibly robust, though highly volatile, growth. It's positioned itself as this scarce deflationary asset.
People call it digital gold for a reason. It's seen as a potential hedge against fiat currency inflation.
So if the long-term growth rate of Bitcoin is, let's just throw a number out there, say 25% annually, and you can reliably get a loan against it at maybe 8 to 10% interest.
Then that positive spread, that difference between the two numbers, lets your net worth grow exponentially faster than your debt. That delta is the profit engine of the entire BBD strategy.
And if that flips,
If that delta flips, if your interest rate is consistently higher than the asset's appreciation rate, you are not in a wealth strategy anymore. You're just in a losing debt cycle. The whole belief in the deflationary nature and the program scarcity of Bitcoin is what gives holders that long-term confidence they need to even consider leveraging it.
okay, so you got the growth potential. Next up is robust network security. I mean, if you're staking your entire family's legacy on an asset, that asset cannot be subject to some kind of catastrophic failure or seizure.
This is where the decentralized nature of Bitcoin is so key. The network has just shown incredible resilience over the years. It's constantly getting stronger, the hash rate is increasing, and its massive decentralized structure means a catastrophic failure of the asset itself.
Like the network just collapsing or a government trying to seize the whole infrastructure.
It's becoming virtually impossible, and that level of durability is what's giving institutional players the confidence to finally enter the space, which in turn validates that whole store of value idea.
And that leads right into the next point, which is institutional adoption. This seems crucial for stability, doesn't it?
Oh, it provides huge validation. When you see major financial institutions, big asset managers, even sovereign nations starting to buy and hold Bitcoin, it sends a powerful signal.
That it's moved beyond just being a retail spec action.
Exactly. It's entering the domain of a long-term global treasury reserve asset, and that institutional acceptance provides a sort of floor of stability and, importantly, liquidity, which is what lenders need to see before they'll accept it as collateral.
Okay, let's talk about that. High liquidity. For a lender to give you a loan, they have to be absolutely sure that if you default, they can immediately sell your collateral to get their money back.
And Bitcoin's liquidity is just unmatched in the digital asset world. It trades 247 globally against almost every currency you can think of. Its market cap is enormous, in the trillions of dollars. A lender knows they can liquidate millions of dollars of Bitcoin collateral basically instantly.
But wait a minute, that 247 nature of Bitcoin.
Yeah.
You mentioned it earlier. It sounds like a double-edged sword.
Yeah.
How does that perfect liquidity actually become a huge risk for the borrower?
It dramatically accelerates the timeline for disaster. That's how...
What do you mean?
In traditional finance, if the stock market drops 10% on a Monday, you might have until the next day, or at least a few business days, to deal with a margin call. You have time to react.
Okay.
With Bitcoin, a 20% flash crash can happen at 3 a.m. on a Saturday. And the liquidation algorithm on these platforms, it doesn't take weekends off.
Right.
This hyper-liquidity and the constant trading cycle demand hypervigilance from the borrower. It's unlike any traditional asset. The speed is just different.
And finally, there's this cultural aspect. This whole strategy fits perfectly with the holder mentality that's already so deeply ingrained in the Bitcoin community. The stack sats and HODL philosophy.
It really is. BBD is fundamentally the ultimate expression of HODL. It allows dedicated Bitcoiners to actually realize the utility and power of their accumulated wealth, to use it for their needs without ever having to violate that core principle of not selling their Bitcoin.
So the buy phase is what they're already doing.
They're already masters of the buy phase. The borrow phase just turns their accumulation into a usable economic tool.
That makes the theoretical foundation really compelling.
Yeah.
But moving from the philosophy of HODL to the mechanical reality of borrowing, that feels like a massive leap. You're going from the safety of your hardware wallet into this hostile, complex financial jungle.
It is. The borrow phase is the advanced maneuver that turns theory into very real, very actionable risk. When you use your Bitcoin as collateral, you're entering into a relationship with a lending platform, whether it's CeFi or DeFi, and that platform holds the power to automatically seize and liquidate your assets.
So your understanding of a few key metrics is literally the difference between preserving your wealth and watching it just evaporate.
Absolutely. There are 3 you have to know inside and out.
Okay, let's start with an analogy to ground this. Let's say your leverage position is like a boiling pot of water. The temperature has to be strictly controlled.
Yeah.
So our first measure is the loan-to-value ratio, or LTV.
The LTV is your thermometer. That's a great way to put it. It measures the amount of your loan against the current market value of your collateral. So if a platform offers a 65% LTV and you put up $100,000 in Bitcoin, you can borrow a maximum of $65,000.
So the lower the temperature, the lower your LTV, the safer you are.
Exactly. And if the value of your collateral drops, the ratio rises, the temperature goes up, and the risk increases. The LTV is just a measurement of the safety buffer between where you are now and disaster.
And that potential disaster is the liquidation point. This is the boiling point, the catastrophic failure threshold.
This is the price level of Bitcoin at which the platform will automatically execute a forced sale of your collateral to get their debt back.
Why does it happen at that specific point? Why not give you more of a chance?
Because the lender has to protect themselves above all else. If your collateral value drops and the LTV goes past their set threshold, let's say it's 85%, they have to act. They don't call you for permission. The automated contract just executes, selling your Bitcoin to make sure their loan principal is covered immediately.
And for the borrower, this means the loss of the very asset they were planning to hold forever. The whole strategy fails.
Utterly and completely.
Yeah.
And sitting right between your safe starting LTV and that catastrophic liquidation point, there's a warning light.
The margin call.
The margin call. It's the final warning siren before the whole thing boils over. It gets triggered when the LTV rises, maybe to 75 or 80%, and it's a signal that your collateral is rapidly becoming insufficient to safely cover the debt.
So what are the critical actions a borrower has to take during a margin call? Because it sounds like time is not on your side.
You might have seconds or minutes. You don't have days. You have to either deposit more cash or more Bitcoin to increase your collateral, which pushes the LTV back down, or you have to immediately repay some of the loan principal, which also lowers the LTV.
And failing to meet that margin call.
Yeah.
Maybe because you don't have liquid cash ready, or you just missed the email alert.
It guarantees that if the price keeps dropping, you will eventually hit that catastrophic liquidation point.
This really highlights that this strategy is not for the faint of heart. It's not passive accumulation. It demands constant, active financial management.
And when you're applying this BBD strategy to Bitcoin specifically, the risk profile just shifts entirely compared to, say, leveraging a steady bond portfolio or a piece of real estate.
The primary risk factor being the inherent high volatility of Bitcoin. We're not talking about small moves. We're talking 30, 40, even 50% drops happening within weeks, sometimes days.
Exactly. In TradFi, a 50% drop in real estate value is a market crash of generational significance. It's a crisis. In crypto, that's just Tuesday. And this extreme volatility, it just compresses the time window between having a safe LTV and being liquidated. It makes constant monitoring a mandatory high-stress 24/7 job.
Yeah.
You are literally fighting against the speed of the market itself.
And that high volatility makes me question the viability of the whole interest and debt servicing requirement. You have to pay interest. You have to eventually repay the principal. You said the spread needs to be positive. BTC growth has to beat the interest rate. But what happens if the market just goes sideways for 5 years?
That is the essential risk calculation you have to make. If your interest rate is 10%, but Bitcoin flatlines for 2 or 3 years, you're just paying a heavy cost to carry that debt with zero appreciation to offset it. You're trapped.
You're losing money.
You're losing money every single day. The viability of BBD with Bitcoin hinges entirely on the sustained long-term dominance of that appreciation rate over your borrowing cost. If you enter into this debt relationship, you absolutely must have a plan to service that interest, even if Bitcoin doesn't move for several years.
But the greatest risk, the one that you mentioned earlier that makes this strategy right now unsuitable for most people, is platform risk, or what you called counterparty risk.
This is the Achilles heel of the entire concept in the current crypto environment. The Bitcoin itself, on its decentralized network, is secure. But to use it as collateral, you have to give it to someone. You have to transfer it to a lending entity, a CeFi or DeFi platform.
And the moment you do that,
The moment you do that, you are exposed to that platform's security, its solvency, and its integrity.
can you give us a clearer picture of what this means? We hear phrases like platforms can fail, but what does that look like in practice for the user?
Okay, so imagine you've deposited $1 million in Bitcoin as collateral on a platform. Everything is working perfectly. You're managing your LTV. Then behind the scenes, that platform CEO mismanages their funds, or they get hacked, or they make some disastrous trading bets with the company's own assets.
And the platform collapses.
It collapses. It declares bankruptcy, or just freezes withdrawals, which we've seen happen numerous times since 2020. Your entire $1 million collateral in BTC is now at risk. And you weren't even liquidated. The platform just failed.
So you did everything right. You managed your LTV conservatively, you serviced the debt perfectly, but you lose your entire asset because the third-party middleman failed.
Precisely. Unlike a regulated, insured bank in the traditional system, many of these crypto platforms, they lack that robust regulatory oversight. They don't have deposit guarantees. The source material highlights this as the #1 reason why BBD is still considered theoretical and unsafe for most. Until the infrastructure matures and platform credibility is absolute, you are risking your generational wealth on the competence and honesty of a centralized company.
This really brings the emotional and psychological weight of this strategy into sharp focus. We talk about diamond hands, but holding 80% of your net worth while borrowing against the other 20% during a sudden 50% crash, that must be emotionally exhausting.
It's paramount. Your psychological resilience is absolutely paramount. Financial discipline is one thing, but managing debt combined with this level of extreme asset volatility, it creates a level of stress that can lead to panic, to poor decision-making right when you need a clear head during a margin call.
So if you aren't mentally prepared to see your collateral value get cut in half and stay calm enough to execute your plan,
then you should not be engaging in this advanced maneuver, period.
to really ground this strategy, let's look at the TradFi blueprint first. Just to confirm that this buy, borrow, die concept isn't some fantasy. It's a proven successful engine for dynastic wealth creation in the existing financial system.
The wealthy execute this every single day with all sorts of diversified assets. Take, for instance, a portfolio of zero-coupon bonds. They buy the bond, it appreciates tax-deferred, and they continuously take out these low-interest non-recourse loans against the rising value.
Using the cash for new investments or just for living expenses, never selling the underlying bond.
Exactly. The debt is managed, and eventually the bond, having reached maturity, is passed on. Or think of high-value real estate. A property is bought, its value grows over 30 years, and the owner just continuously refinances it, pulling out equity, tax-free.
They pay the interest, but the appreciation on the property far outstrips the cost of that debt.
And when the owner passes, the heir gets the property with a massive stepped-up basis, making all those decades of appreciation completely non-taxable. The TradFi blueprint proves the concept works and it's scalable. They are funding their lifestyles with borrowed money, effectively using the government's own tax code to accelerate their net worth.
Okay, so we know it works in TradFi. Now let's apply the harsh reality of volatility to the theoretical world of Bitcoin by using the Mr. Z scenario that was detailed in the community analysis. This really illustrates the danger lurking inside that borrow phase if discipline fails.
Okay, let's track Mr. Z's hypothetical journey from his initial leverage to a potential catastrophe.
So for the initial setup, Mr. Z collateralizes a certain amount of BTC. Let's say it's valued at $100,000. And he takes a high-risk approach. He takes the maximum loan the platform allows, a 65% LTV, borrowing $65,000.
So his safety buffer is only 20 percentage points before he hits that 85% liquidation threshold. It's a very thin margin for error.
The market looks stable for a few months. Mr. Z is successfully paying the interest on his loan. Then, Bitcoin enters a sudden bear phase. Maybe there's a macro shock or some regulatory scare. The price drops significantly.
And now we get to the margin call trigger. The platform's margin call is set at a 75% LTV. Now, for his $65,000 loan to represent 75% of his collateral, the value of his $100,000 BTC position only has to drop to about $86,667.
That's only a 13.3% price drop. That's a tiny move in the crypto world. So Mr. Z gets an urgent warning.
This is that high-pressure moment we talked about. He needs to inject, say, $10,000 in cash or equivalent BTC immediately to get that LTV back down to a safe level, maybe back to 65%. But what if he's traveling or asleep or just doesn't have that 10,000 in liquid reserves ready to go?
Then he's in deep trouble.
He is. So let's move to the liquidation point, catastrophe. Let's assume Mr. Z misses the warning or he just doesn't have the cash reserves. The price continues to fall until the LTV hits the platform's liquidation point, which is set at 85%.
Okay.
At this 85% LTV, the remaining collateral is now worth $76,470. The moment the value of his Bitcoin hits that number, the platform automatically triggers the forced sale.
And they sell everything.
They sell his entire remaining Bitcoin collateral to recover their $65,000 debt plus fees. Mr. Z might get a small sliver of change back, but his long-term HODL position is destroyed, wiped out.
The lesson here is so clear. The volatility of Bitcoin demands you have vast liquid reserves on hand. And it demands a commitment to under-leveraging your asset. Without cash on standby, the entire asset, the one you intended for generational wealth, can be wiped out in an instant.
And again, we just have to reiterate that real-world caution from the analysis. Since 2020, so many of these crypto lending platforms have collapsed. Even if Mr. Z had kept his LTV at a super safe 20%, if the platform itself filed for bankruptcy, his entire $100,000 collateral would be tied up in lengthy, uncertain legal proceedings.
So platform credibility remains the highest hurdle.
The highest hurdle for making BBD viable with Bitcoin, no question.
So BBD with Bitcoin is, right now, an advanced, theoretical, and dangerous game. So what are the key takeaways we can actually implement today, focusing on discipline and preparation for a safer future when this might be viable?
Right. Since the full-scale, safe implementation of this is still aspirational for most of us, the actionable steps really have to focus on maximizing security and building that financial discipline you would need to eventually manage this level of debt and risk.
Okay, takeaway number 1, safety first. Stack sats and HODL securely.
The priority has to remain the core Bitcoin strategy. Accumulate diligently, but enforce strict conservatism. Keep the vast majority, we would suggest at least 80% of your holdings secured in a personal, offline hardware wallet.
So that 80% is your untouchable generational wealth.
Exactly. It should never be exposed to a third party or used for collateral until the lending landscape is radically and reliably regulated.
Okay, takeaway 2. Implement the 20% rule in reserve planning. So if, and it's a big if you ever decide to engage in collateralized borrowing, you strictly limit your exposure to no more than 20% of your total Bitcoin holdings.
And that 20% has to be managed very strategically. This is where that deep financial discipline comes in. So within that risky 20% allocation, you divide it again. Use 75% of that 20% for the actual collateral against the loan.
And the other 25%.
The remaining 25% of that 20% should be kept separate as a liquid emergency reserve, either in stablecoins or in cash.
This reserve is critical. This is the money you use if a margin call happens. You use this separate pool of money to top up the collateral, preserving your core asset and preventing that catastrophic liquidation.
Exactly. You are essentially pre-funding your own risk mitigation. By doing this, you completely shift the risk profile. You're now only risking the 20% that was exposed to begin with, and even that is protected by your ready cash reserves. That preparation is what dictates success or failure.
All right, takeaway 3. Borrow conservatively. Aim for a really low LTV. Don't get seduced by the maximum loan amount a platform offers you.
A 65% LTV is a strategy designed for an extremely high risk tolerance. In a volatile asset like Bitcoin, it's practically designed for failure. To create a vast buffer against those sharp market drops and to massively reduce the stress of constant monitoring, you should aim for a significantly safer margin.
Like what? 20-30% LTV?
20 to 30%, absolutely.
Why is 20% LTV so much safer? Can you break that down?
Sure. At a 20% LTV, your $100,000 collateral only secures a $20,000 loan. For your LTV to even hit the typical 75% margin call threshold, your collateral would have to drop by roughly 75%.
Wow, all the way down to about $26,000.
Right. That massive buffer gives you ample time, mental space, and financial flexibility to react even during the most severe crashes. Conservative borrowing is the single greatest tool you have for mitigating volatility risk.
Okay, takeaway 4. Discipline is paramount, and you must plan for debt servicing.
You have to understand that taking on debt is not an escape from responsibility. You must have a sustainable, non-leveraged source of income to service the interest and, ultimately, to repay the principal. Do not borrow beyond your means to pay that debt service.
Especially since the market could go flat or even decline for extended periods.
Exactly. This requires budgeting. It requires treating those loan payments with the utmost seriousness.
And finally, takeaway 5. Continuous education.
This landscape is evolving so rapidly. Tax laws, regulations around crypto-backed loans, the credibility of lending platforms, it's all in constant flux. You have to commit to continuously updating your knowledge, vet every platform thoroughly, understand their exact liquidation mechanics, and fully grasp how your specific jurisdiction treats things like the step-up basis and interest deductibility.
And until you're confident in all of those advanced areas.
The risk-to-reward ratio is just simply too high for most people.
So we've taken an exhaustive deep dive into the buy, borrow, die strategy, this tax-efficient financial maneuver of the ultra-wealthy, and we've explored its potential adaptation using Bitcoin as the collateral.
And BBD with Bitcoin, it does offer this powerful, potentially generational path to accumulating wealth, leveraging Bitcoin's growth while using strategic debt to maintain liquidity. But, and it's a huge but, it is an advanced financial tool that currently requires deep knowledge, meticulous risk management, and a reliable infrastructure that, frankly, does not yet safely exist.
So until these lending platforms mature and regulations start providing real consumer protection, the safest and most effective strategy remains what it has always been: accumulating Bitcoin and holding the majority of it securely offline, far away from any counterparty risk.
That is the true HODL foundation.
We really encourage you to reflect deeply on your own risk tolerance and your own debt management skills. If this strategy does become fully viable and safe in the future, are you prepared? Are you prepared to service debt while watching your core asset potentially fluctuate by 50%?
Because the ability to use this cheat code successfully rests entirely on the financial discipline that you build today.
If this deep dive resonated with you, and you want to explore more of these advanced wealth strategies, please share this with someone who might find it interesting, and join us for our next exploration into the numbers and ideas that are driving the future of finance.
Until next time, keep digging deeper into the sources.